Now, Charles Dow, many, many years ago, had a very simple philosophy of investment, using technical analysis as his base, noting these patterns or ways in which the market would move. And Charles Dow's approach to the market is commonly known as his 1/3 rule. And very simply, it worked like this. Dow would watch the market in a bear phase, noting that each of the highs was lower than the previous high, and each of the lows was lower than the previous low. He would wait for a technical signal, for example, the market recovering to a point that was higher than the previous high, and he would think to himself, perhaps the primary trend is about to change. He would wait for further evidence and note that the low that was formed was in fact higher than the previous low, and that the market was rising now to a new high. At that stage, he would look to the possibility of the market reversing from a bear into a bull trend. However, it was a very conservative approach because he would have watched the market drop, let's assume by 1,000 index points during the bear phase, and he would now wait for that market to recover 1/3 of its previous losses. In other words, he would wait for that market to recover 333 index points. And at the time that it had recovered the 333, or 1/3 of its losses, he would buy shares within that market. He would then wait out the bull run as the market rose higher and higher, and at the time where the market showed signs of converting from a bull to a bear, in other words, we had a lower high and then a lower low, he would now watch the market fall off, go into the bear phase, but he would wait, before he sold his shares, he would wait until the market had lost 1/3 of the previous gains. Let's assume that the market in the bull run had gained 2,000 index points. Charles Dow would now wait for the market to lose 1/3, or 666 of those points, and at that stage he would sell his shares. It was a very conservative strategy, which meant that Charles Dow was really making his profits out of that very safe 1/3 band in the middle of the market. And in effect, he was sacrificing the potential profits that he could have made at the bottom and at the top of the market. However, despite this, the followers of Dow have looked over a 70-year cycle from the year 1900 to the year 1970, and they've compared the 1/3 rule against a buy and hold strategy. Now, buy and hold simply means that you buy your shares in the year 1900, you hold them for 70 years, and you see what they're worth. And under a buy and hold strategy, if you'd have taken an investment of $50 in 1900, it would have been worth some $960 in 1970. However, using the 1/3 rule, in other words, trading your shares, trying to be in the market when it's rising and trying to be out of the market when it's falling, even with a very unsophisticated approach as the 1/3 rule offered, the $50 investment that you would have put into the markets in 1900s would have grown to an $18,000 return in 1970. Proof that in order to make substantial profits out of the stock market, you have to be prepared to trade your shares. You have to be prepared to look for the opportunities so that you're in the market when it's rising and that you're out of the market when it's falling. The opportunity we have today with the much more sophisticated techniques that we have available to us can far outstrip that performance. My task from here on is to share with you some of the technical approaches, some of the aspects of technical analysis that you can put into effect immediately in the stock market in order to appreciate some of the gains that are available to you within the confines of the bull market.